Four pillars of business strategy, financial strategy. This is the second part in a four-part series where I walk you through the four pillars of business strategy. Today is pillar number 2, financial strategy. So what's up, everybody? My name is Chris Hervochon. The website is betterwaycpa.com, and let's dive into it. The four pillars of business strategy is really something that I like to dig into in my Wayfinder. A Wayfinder is a service that I offer. And basically what it is a 1-hour introductory fact-finding meeting where we sit down, we chat, and we go through what your business is, what it does, who you serve, how you serve your clients, and all the different processes that go into your business. From that, I take that information, I compile some research that I do on my end, and I turn that into an 8 to 9 page document, which is the plan. So the plan talks about the state of the industry and the economy, how that's going to impact your business. Benchmarks you from a ratio perspective as well as from a revenue and an operating margin perspective against your competitors in your industry. Do some KPI development to show you what you should be managing in your business to turn your business from the business that you have and into the business that you want. And then we do a financial process assessment. So how is your business operating from an accounting and finance perspective? How should it be operating to get you the optimal results? And what do you need to do to change your accounting and finance function into something that's more efficient and that generates better data for your business? Then I provide you with a list of next steps, so basically 5 next steps on what you need to be doing in your business to implement these strategies and these tactics. Then we sit down again, we go through the plan in a 1-hour meeting again, and I basically walk you through all of that and what the Wayfinder shows you. So, business strategy focus areas, these are the 4 pillars of business strategy. Customer acquisition and sales, that's the first pillar. That's the pillar that we discussed in the last video. Financial strategy, that's pillar number 2. That's what we're going to be talking about today. People and culture, so do you have the right people? Do you have the right number of people? Are they doing the right things? What is the culture like in your business? And then risk management. So what do you need to do in your business to mitigate risk and to make your business as stable and as long-lasting as possible? So this is some KPI development around financial strategy. And this should look familiar from the first video, but it's a little bit different. So in this particular case, the operating profit target is $60,000 for this particular business owner. Their current revenue is $200,000. Their current operating profit is $50,000. So $50,000 is obviously less than the target of $60,000. Their current operating profit percentage is 25%, so that's $50,000 divided by the top line revenue of $200,000. On average, the industry is operating at a profit percentage of 30%, so 30% is greater than 25%. This business is not operating as efficiently from a cost perspective as their peers. And so we take the greater of the company or the industry average profit percentage, which is 30%. That's where we want to get to. And then we look at the profit target, so $60,000 divided by 30%. They really want to get to a $200,000 revenue, top line revenue number, but that's where they're at. So that's great. So they've already achieved that top line revenue target that they need. They do not need to be worried about customer acquisition and sales. What they need to be worried about is operating more efficiently from a cost perspective. So the recommended KPI focus here is financial strategy. Now over on the right, we see the financial strategy KPIs that are identified for this business. So gross margin percentage by the overall percentage, and then by customer, and then by product and service. So that'll tell us which customers are profitable, which ones aren't. That'll tell us which products and services are profitable, which ones aren't. And then we can start to make adjustments. So should we still be servicing these customers that are not profitable? Should we still be offering these products and services that are not profitable? Good question. So what are the top expenses as a percentage of sales? Are you spending too much on meals and entertainment? Are you spending too much on software? Can you cut costs in software? Can you cut costs in meals and entertainment? Can you cut costs somewhere else in the business? We should rank those. We should look at those try to figure out where the fat is, and then cut those as much as possible in order to get us from that 25% to the 30% operating profit percentage that we want to see. Similarly, cash conversion cycle. So it's nice that your business is profitable, but is the cash coming into the business? So just showing paper profit is not necessarily what you want. You need to actually have the cash to back that up. Otherwise, it's just a paper profit. Doesn't mean anything. Profit can be whatever you want it to be, right? On paper. Inventory WIP on hand. So are you managing your inventory optimally? Are you spending the right amount of money at the right times on inventory and on work in process? Altman Z-score, I've touched on that in other videos, and those are going to be linked, that video is going to be linked in the show notes to this video. But basically, that's a measurement of your overall business health. And then vendor discounts awarded. So if you're taking advantage of vendor discounts, that means that you're actually buying the goods or services that you're going to resell a little bit cheaper than you otherwise would. So that increases your margin. All good things. So here are some examples of some financial strategy tactics. Cash flow forecasting. How often are you looking at the cash flow forecast in your business? And if it's never, that's not good. You need to do it at least on occasion so you have an understanding of what cash you can expect coming in, what cash you can expect going out, and then that can start to inform your management processes. Cash conversion cycle. So how quickly are you turning revenue into cash? Are you taking advantage of discounts? We already talked about that. What does your margin look like? Do you need margin expansion? Do you have items where you don't, or items or customers where you have no margin? What are your operating expenses? We talked about that as well. Accounts receivable turnover. So how quickly are you turning that revenue into cash? Then doesn't need to be faster. Inventory WIP levels. We spoke about that as well. Accounts payable cycle. So are you taking advantage of when you should be paying and how much you should be paying? So maybe you shouldn't be taking advantage of discounts. Maybe you should be paying slower because you do have that cash flow problem. Is your business well capitalized? And how are you capitalizing it? Are you capitalizing it through customers? In other words, sales, where a customer buys your good or service, they give you cash for it, and then they use that as capital to grow the business. Are you taking out loans? So you're going down to the bank and asking them for money that you're going to repay back, or that you're going to pay back over time? Or are you bringing in investors where they get a piece of equity in the business and in exchange they capitalize the business so you can use that cash to then grow? Budgeting. So similar to cash flow forecasting, do you have a budget? Do you have a plan? Do you know where you're going to spend your money and how much of that money you're going to spend on certain items? It's a very good exercise to go through at least periodically, at least once a year. Can you refinance or consolidate loans? So that goes back to the capitalization question. If you refinance or consolidate, you might save on interest expense. That might make your business more profitable. That might increase your cash flow. And then finally, margin analysis. And that gets back to, do you have customers and services and products that are all profitable? So some final thoughts on this. Financial strategy should be the second priority when moving through the 4 pillars of business strategy. Your top line revenue, that's your first focus. So if you don't have revenue, you do not have a business. The second step is making sure that revenue that you're generating is turning into an efficient bottom line number, and also that bottom line number is backed up by the cash received. Okay, so one of the main goals of financial strategy is to cut unnecessary costs and to increase cash flow. So you don't want to be spending money all willy-nilly, and you also want cash to be coming into the business so then you can pay your people, you can pay your vendors and suppliers, and that you yourself can take some of that cash out of the business to finance your existence, because that's the purpose of being in business, is so that you can deliver a good and service the way that you want to deliver it, in a way that gives you joy, gives your customers joy, gives your employees joy, but also that supports your existence as, just a human being, paying the mortgage, putting food on the table, right? And then finally, number 3, financial strategy is about becoming more efficient with the profits and cash generated by the business. In other words, gaining the most benefit from the top line. So when you go in business, is very much eat what you kill, right? So whatever you go out and sell, that's what you get, okay? But we want to make sure that when we sell something, we're getting the most benefit from that activity as possible. And then that also will make your business more stable, make sure that it can actually stay around for a long time. Because if you're not well capitalized, you're always going to struggle. Having enough capital is great. The cheapest capital that we can get is capital that's provided by our customers as opposed to loans or investors. And the only way to get capital from your customers is to sell to them and then turn that sale into cash, and the most cash possible. Okay, so that's it for me today. These are the resources for this video. The marketing agency sample Wayfinder is linked here. There are a couple Quora posts that I wrote around financial strategy, which I think you may find helpful, as well as a couple of YouTube videos. One is how to measure your business's financial health. That covers the Altman Z-score, which I just talked about a couple minutes ago. And then the 555 profit analysis, which is a great video to look at to give you an idea of what the possibilities are. So what happens in your business if you take your top line revenue, you increase it by 5%, you decrease your cost of goods sold by 5%, and then you decrease your operating expenses by 5%. It's a really cool exercise. I think it's really eye-opening for a lot of business owners. And you can actually do that analysis with even a smaller percentage. So what happens if you increase your top line by 1%, cost of goods sold decreases by 1%, OPEX decreases by 1%, what happens to your bottom line? It's a really fascinating exercise. I would encourage you to go look at that video. Let's connect. Chris@betterwaycpa.com. That's the email address. Phone number 843-608-0298. You can find me on Facebook, LinkedIn, Twitter, Quora, Instagram, and Pinterest. So everywhere on social media, I'm happy to connect with you. If you like this video, please like it and share it on social media and on YouTube. I really appreciate that. It helps me to grow my audience, and it helps me to figure out what I should be putting together videos on going forward. So I really appreciate that. Thank you so much, and I will talk to you next time.